Good morning. Thanks for tuning into BHG, Financial Investments and Securities. I am your host, the Wall Street Parlay. Thanks, guys, again for tuning in. Please don't forget to like, subscribe, and comment. Again, please don't forget to like, subscribe, and comment. That definitely helps out the YouTube channel. And I want to get this information out to as many people as I can and to help out within the community, within the stock investing community. So please, again, like, comment, and subscribe. It definitely helps out the YouTube channel. Today I want to talk about Disney stock, Walt Disney Company. This is a name that is very near and dear to all of us. Growing up as children, we all celebrate Disney. Disney's a phenomenal company. And they've had a pretty good run. Right before the pandemic, Disney stock price was about $80, and that's incredibly low for Disney. So, if you could really have gotten in right before the pandemic and bought the stock at 80, then you've definitely seen some substantial gains, and that's what we like to see. But no one can really predict where a stock is going to bottom, so that's almost an impossible game. And doing it, more than likely, you end up losing principal, and you don't want to do that. So let's get started. Let's talk about Disney. The mission of the Walt Disney Company is to entertain, inform, and inspire people around the globe through the power of unparalleled storytelling. Through the power of unparalleled storytelling, reflecting the iconic brands, creative minds, and innovative technologies that make our world premier entertainment company. They make our world's premier entertainment company. That's weird. That's worded kind of weird. Let's try that again. The mission of the Walt Disney Company is to entertain, inform, and inspire people around the globe through the power of unparalleled storytelling, reflecting the iconic brands, creative minds, and the innovative technologies that make ours the world's premier entertainment company. Well, I guess that is true. I mean, Disney is the world's premier entertainment company. I mean, they're amazing. This is probably one of my favorite companies, honestly. I just love what they're doing as far as the different vertical lanes that they have. I mean, when you talk about Disney, I mean, it's just, we can go on and on about the assets that they've accumulated within a very short amount of time. We're talking about ESPN Plus, we're talking about Hulu, we're talking about Marvel, we're talking about FX. Wow, I mean, it just goes on and on. And I haven't even begun to even touch on Disney Plus, so that's a completely different asset that puts them also within a different industry, within streaming. And that's a really good lane to be in, especially coming, not really coming off the heels of the pandemic, but during the pandemic. So Disney definitely was able to capitalize on that. I think they really pushed Disney Plus out a little bit too soon before they really worked out all the bugs. But it's been phenomenal. I mean, I love Disney Plus. I'm pretty sure everyone else does too. So it's a great streaming service, and I do enjoy it. So let's get started. Let's talk about Disney. The current stock price is $173.70. It's not bad. It's not horrible. Right now, I wouldn't invest in Disney at this particular price point because I do think it's a little high, considering where its 52-week low was. Again, we always want to make sure we invest around the 52-week low mark. Currently, the 52-week low mark is 108. 108. So, before I'd invest in Disney right now, I'd wait until it got a little bit closer to that 108 mark, somewhere around maybe 110, anywhere 110 to 115 range. If you can, capture it at that point, then, that's a really good place to be on the stock. But I don't know. I don't see it really going back down to that low. But for me, as an investor, as a really a value-oriented investor, I don't think I'd buy this stock at $173.70. And again, I love the company, and the growth ahead of it is amazing. But I do think $173.70 is a little bit high for an entry point price. Now, if you're already in the stock and you are trying to cost average, go down on your cost that you have in, then yeah, I mean, it depends on where you are, but still, even with that, I still think $173.70 is a little bit high. But it depends on where your initial investment point is. It depends on where your cost average point is. And we'll talk about cost averaging a little bit later to give you guys a deep understanding of how to cost average down on each one of your positions, and that's critical for a long-term investor. You want to know how to do that. But right now, Disney's price to earnings ratio, let's take a look at some of their numbers. It's like, wow, okay. Gee. Geez. Yeah, man, I didn't think it was going to be that bad. Price to earnings ratio is 233.64. It's really high. But again, that's coming off the heels of the pandemic. So you have to take these things in consideration. Disney's price to earnings growth ratio is 10.70, which is substantially, actually exponentially higher than where we want to be. We want that number to be less than 1. Price to earnings growth, again, we're talking about price to earnings growth. So you definitely want that to be low. It's a ratio reflecting that price to earnings growth. So, and right now, 10.70 is, it's really high. It's really high. That's probably one of the highest PG ratios I've seen in a while. The return on equity, and again, this is return on shareholders' equity. This number is critical to let investors know how the company is performing. How are they handling the equity that the shareholders have put into the company? This is extremely important. I'm sorry, my headphones are making a crazy noise, but that's important. That's very important. And we want this number traditionally to be above 20. Anything greater than 20 is great. Right now, wow, they're at a negative 5.67. Again, the number is negative 5.67. So Disney isn't doing well from a numeric fundamental analysis perspective. They're not performing well at all, which is not good. Return on invested capital for Disney is 0.71. Your return on invested capital that's been put into the company, to help grow, it's 0.71. That return is dramatically low. Price of sales 5.52. It's still bad. It's not horrible, but let's take a look at the annual growth. Wow. So coming off the heels of their numbers for 2020, again, this was the year of the pandemic. So, of course, these numbers are going to be slided. So right now they have a negative 19.18% annual growth rate. Again, negative 19.18% annual growth rate. Wow. Free cash flow growth rate, negative 28.90%. And this is a number that's very critical. This is a number that investors really look at because you need to know how the company is performing in terms of free cash. This lets you know what the company can do. You really want that free cash coming in, free cash flow. A great cash flow really lets you know that the company is performing. Let's see. Debt to equity ratio. Debt to equity ratio, you really want this number to be lower than 2. Right now, it has a 0.60. So, it's not bad. That's not bad at all. Their quick ratio, how well the company can pay down its debt, this number needs to be above 1, and it is 1.26. So that's not terrible. And in the future, I'm going to have a screen to where I can show you the information that I see. You can have access to my screens, and it's almost like a screen sharing mechanism to where you are also able to kind of walk through these stocks and see what I'm seeing. So it's not like I'm just sitting here, telling you the information, but you're also able to see it with me. I really want to get that done for you guys. And hopefully in the near future, I will be able to do that for you. So, in a nutshell, would I invest in Disney right now? I don't know. I mean, I probably would not, considering the price point of $173.70. If I hadn't already been invested in the company, I don't think I'd invest right now. Not into Disney. I really don't. And, considering everything, moving forward, where it's going, based on present valuation, I don't think Disney's a good buy right now. I really don't. Now, if the number drops to maybe 150 and 155, valuation starts to look more attractive at that point. But right now, price to earnings growth, it's numerically, fundamentally, the company just isn't, it's not fundamentally fit right now. And that's something that you really gotta look at in terms of investing long term. If you're in swing trading and things of that nature, that's a totally different way to. It's a totally different way to evaluate companies. That's different. But yeah. So right now, I wouldn't rate Disney as a buy. Let's see what the streets are saying. This is one of the reports I really like to look into. The streets, they normally give pretty great analysis points on companies, and even they have it as a hold. And most people that are long-term invest in Disney right now, they are holding, myself included. So it's you got to be really careful where you cost average at. So, for me, I wouldn't cost average here. Definitely not. I'd wait until at least anything below 100. Me personally, but again, that's optimistic, right? You just optimistically thinking that this company is going to drop that far, and no, I don't think so. You really want to hold on to Disney. It's not a company to sell. It's not a company to buy right now, but it's not a company to sell either. So I definitely understand the rating of a hold because it makes the most logical sense for Disney. But it's a beautiful company. You cannot deny where it's going, and you can also not look over the amount of assets that they've accumulated. You cannot. So yeah, take these things into consideration when looking into Disney. But a couple of things I wanted to go over one more time. Price to earnings growth projected over the next 5 years, very, very important in terms of a fundamental analysis. Price to earnings ratio, extremely important in terms of a fundamental analysis. These are things, debt to equity ratio, return on equity, return on invested capital, annual growth rate. That's always important in terms of any growth company. Make sure that company has a great annual growth rate and that it's consistent and that it's continuous. And you don't really want, if there are years where the company is sliding back, make sure you understand the business model and understand why that's happening. Understanding the business model of every company is extremely important. So make sure you know how that company makes revenue. If you don't know how the company is generating revenue, then how can you truly understand the company? This is kind of one of those things where if you're going to invest in something, you need to make sure you understand it. Have a high level of understanding it financially and where they're going. What is their competitive advantage? These things are extremely important. With Disney, in terms of a competitive advantage, they're in every space. They really have no competition. So they are excelling in their own version of a competitive advantage because they have no competition. So if you're not in Disney, then I think it's a little bit too high. I do. I really think it's a little bit too high. But again, guys, I'm signing off. This is the Wall Street Bully. And I'm going to try to provide some content for you every week, if not every day. So again, do not forget to like, comment, and subscribe. Do not forget to like, comment, and subscribe. Love you guys. Take care. Be blessed.